So, good evening. Thanks everybody for coming. I'm David Llewellyn Smith. You probably know me as Houses and Holes, or as the RBA calls me, that macrobusiness bastard. So Leith's given us, a wrap of, kind of the internal circumstances of the Australian housing market. And we can see that there are a number of kind of adjustments and shocks ongoing there that make it quite vulnerable. What I'm going to do now is place that in a global context and see what is right now an orderly adjustment for house prices, how that will transpire with respect to what's coming down the pipeline in the global economy. You can't hear me? Yep, okay. So right now the global economy is dominated by the US. We have an outrageous Trump boom, which is outrageous for a number of reasons. Probably the main one is he gutted the US budget to give huge corporate tax cuts and big tax cuts to the rich, a few tax cuts to the poor, and that has helped trigger a big lift in the stock market. He's now got tariffs going on as well to try and repatriate some production from exports, etc. And that throws up a kind of interesting endpoint for his boom, and that is, at a certain point, all of that money which is coming out of the budget, basically, it resets and becomes a fiscal cliff 12 months out. So that's a very basic representation of this, which shows right now we're in the midst of the Trump boom, but by 2020 it will be going bust all by itself. So just bear that in mind as we move on. The Trump boom's probably got 12 months to run. Then it will naturally fizzle out owing to these fiscal cliff. But of course, that gives him 12 months to pull another rabbit out of the hat. So Europe has been through its own little boom coming out of the 2015, sort of 2016 slow global economy. There was a big inventory build. Europe boomed as people restocked, and you can see a nice spike there in European manufacturing, and now that's coming off really fast, and we expect Europe will continue to slow. And this is the big one, of course, for Australia, China. You'll notice in this chart there are three mountains. Each one represents a very large Chinese stimulus, which, as we know, gets funneled into its housing market and into infrastructure, by and large. And this is, them building bridges to nowhere, enormous numbers of empty apartments, ghost cities, and all of the, that reputation. If you look at the pricing for Australia's key commodities, they basically just track these three mountains. So this is Chinese broad credit, which is what funds the stimulus. And as you can see, we've been through these three, and at the moment we are coming off the last mountain and falling pretty fast. So this tells us, this is basically the key indicator for where Chinese growth is going. So moving into next year, we've got US boom still on, slowing Europe, and we will also have a slowing China going into 2019. So what that means, if you put those three things together and you add the trade war, you get a scenario in which you get a very strong US dollar. Money starts to chase US growth. The euro falls because their growth isn't going so well. The Chinese yuan starts to fall because their growth is easing pretty quickly. And the US kind of becomes the investment of last resort in this scenario. And so we see the US dollar rise. This chart is the result of that rise. This is the chart of junk bonds in emerging markets, which are kind of the highly sensitive high risk investments that global capital chases when risk is on. When everything's good, they go for the high yield stuff on the fringes of the global economy where they get really high returns. Then when things start to slow and turn sour, and if the US dollar is rising as well, that capital starts to come out of the fringes and go back to where it came from, which is the US. The orange line is emerging market junk bonds. As you can see, it's been through a big crash into the end of 2015, which was the global commodities bust. That was the first round where we saw a rising US dollar. We had a couple of years where the US dollar came off and China stimulated, but we're back to where we started. And so emerging markets are also in trouble. And so this, again, it becomes a kind of feedback loop story where everywhere but the US slows, the US is booming because it was a stimulus, and so on it goes, onward and upward with the Trump boom and the US dollar. So how do we put Australian housing into that context? Well, I mean, we see kind of three possible outcomes to the way things are going at the moment. One is that last chart could actually blow up the global economy. You know, at a certain point when you get emerging market capital flight, the early stages of it are fine. People know which economies are vulnerable, they know which markets are vulnerable, which currencies, etc. But the longer it goes, the higher risk it becomes, and you can get the type of circumstances we saw in the Asian crisis, where we had long-term capital management suddenly crack. You get a big hedge fund, a big player of some sort, highly leveraged, that's just put a lot of money in the wrong spot, and the volatility kills it. And suddenly you go from, you know, what was an orderly correction into a real run and a bust. So the first scenario, the possible scenario, is an emerging markets bust. And that would eventually work its way back into the US and cause its economy to crack as well. It would take down the stock market there, and eventually you would see the Fed ease interest rates, and the US dollar would eventually fall and sort of re-liquefy the globe. So that's possible scenario one. Scenario two is kind of trade war related, in that we have Trump throwing tariffs at China as quickly as he's able. We think that will probably continue. It certainly doesn't look like there's any deal that could prevent it. And so you could get an acceleration in the trade war that results in damaging growth to both the US and China. And again, you end up with an explosion of some sort. There is an alternative scenario there, though, which is nobody wants to lose the trade war, right? It's a really bad look. So Trump puts in tariffs, China's growth starts to ease, they hit the gas. So they do what they've done in that earlier chart with their three mountains. They can do it again, they still have the scope for it. They just start to build a whole lot of shit. Commodities go up again, and the US can't sit there and watch that happen, so they do something similar. Trump's already mooted doing a lot of stuff on US infrastructure. If the Dems get in at the end of the year, they love infrastructure. We could see the US stimulate hard next year as well. And so you'd actually get a counterintuitive boom as these two economies go at each other, which would kick out any correction for another year or two. So all of these things are possible. So if we look at how this kind of transpires for, you know, what is currently an orderly adjustment for Australian housing, this chart is the key. This is BBSW, which is the bank bill swap rate. This is the rate at which basically banks can lend to each other, and this one sets all sorts of funding costs for the banks. As you can see right now, the red line is has spiked, and that's the bank funding costs that have spiked in the last, well, over this year. That's partly the Royal Commission, we think, but it's also partly all of those dynamics I'm talking about with repatriating US dollars, flowing out of emerging markets, etc. It's just harder for our banks to get money. So in our scenarios, if our funding costs stay elevated like that, and two of those three scenarios, the negative scenarios that play out, then that could get much worse. This is where we come to the difficulty facing Australian authorities with interest rates at 1.5% now. If we had a funding spike owing to a bad offshore shock, then there's maybe 2 rate cuts left. The RBA doesn't want to go below 1%, so it says, because it's afraid that it would crash the dollar too far. So that means it's got almost no scope left to offset these rising funding costs. So it means that if you've got a mortgage in these circumstances, households are freaking out, the stock market's dropping, consumption is drying up, and this would be happening across the Western world, and the RBA gave everybody like 400 basis points of easing in the GFC, can hand out nothing. So, households will be very shocked, I think, if that transpires. That's not to say that it is going to transpire next year. As we said, we've got these different scenarios to juggle. But I guess the thought I want to leave you with is that we're right now managing an orderly adjustment in Australian housing. Even so, it's very likely to be probably the deepest adjustment we've seen since 1990. 10 or 15% seems fair, but if it runs into this, it will turn unruly. So I guess what I'm saying is right now the business cycle is being very kind to us, and in some ways, APRA and the RBA are doing an okay job of deflating their previous mistakes, but circumstances are very benign for them to do it in, and it could turn nasty. The second, of course, possible fix in that is the budget and fiscal stimulus. And would we see much of that if we saw another global shock? Yes, we would, but not the same scope that we saw during the GFC. The debt stock now is just too high. It's low relative to the rest of the world, most certainly, but you wouldn't see a crazy amount of spending, fiscal spending coming out, because they would strip the AAA rating pretty fast, and because that guarantees the bank's offshore debt, you would see that funding spike get worse as we got downgraded. So they'll be somewhat cautious on fiscal stimulus. Basically, it means as we go into the end of cycle, the Australian economy is vulnerable, more vulnerable than it's been in several cycles, and the Australian housing market is equally vulnerable at the wrong moment.
Do you think Llewellyn will take that into account?
Why don't we leave that? We'll take that as the first question at the end, because there'll probably be quite a lot of discussion on that reform. So thank you very much, and I'll leave you with Damien to discuss the investment implications.